Hi everyone, this is AJ Brown again, and I was just thinking through why I am so enthralled with equity options. And the scoop is that equity options give me the flexibility to do whatever I want pretty much on my own timing, right? If it comes to just buying things like stocks, commodities, or currencies on the foreign exchange, I have to wait for the signals to either buy or short these type of commodities. When it comes to options, I can take the options themselves and optimize them through different sorts of expiration dates and strike price selection, and I can also combine them. In fact, a mathematician came out recently and said, hey, there's 27 different ways to use options to make profits. And so that flexibility to be able to see any pattern out there and then use options accordingly and optimize to make the most out of the pattern I'm seeing is why I've always been attracted to them. They allow me to do investing more on my time and still get the type of returns you can get as being an active investor. So I thought I'd take a moment today and just kind of take the curtain away from what options are for those of you out there who might be interested in investing in these things, but you really haven't wrapped your head around them. And for those of you that know a lot about options, I bet as we take a deep dive into some of these topics that you indeed will pick up something you didn't know before. And by the way, if you like any of my content, please take a moment and follow me, right? Because I've got some podcasts out there. I'd love for you to look me up on Spotify and iTunes and Google Play, as well as any other podcasting place you go to. I'd love for you to find my channels on YouTube. I'd love for you to take a look at me on my Facebook profiles and on my Instagram profiles. I post content to all of those places, and I try to vary it up a little bit. So it's important that you go to all four and, number one, like what you see there. If I'm giving you value, man, smash that like button on all four of those: the podcast, the YouTube channels, the Facebooks, the Instagram, and please subscribe and turn on the notifications so when I send you new content that you're ready to digest it. Not only will that be a benefit to you, that'll help me because I'm working at kind of getting those algorithms to like me a little bit more. But let's get on with the content, because a lot of people are asking, what are options? Well, I want you to know that options are actually an investment vehicle, like all kinds of other ways that you can invest your money, but they're not anything like shares of stocks or commodities that are issued by a company or represent something as pieces of ownership. Instead, these things are called derivatives. Now, what does that mean? That means investors like you and me create these things. We create these options. What they are legal agreements between a buyer and a seller, and it defines what that buyer can do with some sort of underlying asset that that option is against. They can either buy or sell that as per this legal agreement. And the legal agreement defines what price, we call that the strike price, and for how long that option agreement exists, how long before it expires. This agreement gives these buyers rights, and it obligates the seller of these agreements to fulfill those rights. And in exchange, the buyer pays that seller money to get this agreement written and in their hands. So you might say, okay, what price do these option agreements get sold and bought at? Well, buyers and sellers, they derive these prices of these agreements from these components: the current value of whatever the underlying asset that agreement is about, whether or not the agreement is for buying or selling the underlying asset, whether it's a call or a put, the price set for buying or selling that underlying asset, that's called the strike price, how long before that agreement expires, what's the expiration date of that agreement, and the supply and demand for agreements exactly like the one that's being written up right now. Now, these options absolutely can be standardized because the legal details of these agreements, they can be negotiated and settled upon, usually with lawyers' help. But when you start to get the legal teams involved and you go back and forth on little nitpicking, that's very time-consuming and often expensive. And usually these uniquely negotiated option agreements, they're reserved for when the underlying assets are something big, like a real estate or a big business. Instead, what we talk about here and what we most commonly trade on the open exchanges are what we call standardized agreements. These are agreements where buyers and sellers have agreed upon boilerplate legal terms, and the only four things of these agreements that change are what the underlying asset is, stock, index, ETF. If the agreement is for buying or selling the underlying asset, whether the agreement is to get a stock called from the seller or put to the seller, what the price is set for buying or selling that underlying asset, we call that the strike price, and of course, how long before that agreement expires, what's the expiration date. And just know that once this agreement is created between the initial buyer and seller, they can be bought and sold. Like I said, once an option agreement exists, it can be bought and sold. The current value of the option agreement may go up or down, and again, that depends on the value of the underlying asset at the moment, whether there's been changes in supply and demand for this particular type of agreement, and how close that option is to expiring. The original buyer may decide to sell their rights to someone else, and the original seller may decide to buy back the agreement to release themselves from their obligation. In fact, there's a whole open exchange for buying and selling these standardized option agreements. You'd be surprised to know that option agreements can be bought and sold tens, if not hundreds or more times before they expire. So what I'd like to talk about right now, just very quickly, is this thing called a call option. Now here I am, and here's my friend, and what would happen if I write, which means I'm going to sell to open, a call option to this person. So I'm going to get paid a premium. That's the going price for the option to write or create this option by selling it to this buyer. The buyer is going to pay me a premium to buy this option from me. So money is going to go from her pocket to my pocket. The buyer is going to get the right to buy my underlying symbol at the strike price anytime between now and when the option expires. Now, of course, that's in the American exchange. European options, you can only exercise them when the option expires. For American options, it's any time between now and when the option expires. And I'm going to be taking on the obligation of selling my underlying symbol at the strike price if the buyer comes a-knocking. So the buyer gets a right, and I get the obligation. But I get the money as well for giving the buyer the right in the form of this standardized legal contract. So what if the buyer wants to exercise her call option, exercise her right in that standardized legal call option agreement? Well, she's going to pay me the strike price amount. So money is going to go from her pocket to my pocket. And the buyer is going to get the underlying symbol. And I'm going to give her my underlying symbol. So what's important for the seller is either they have the underlying symbol in their control, that's making sure that your call option is covered, or that you have enough cash, and you have to, this is very difficult because, of course, the underlying asset or symbol can change in price, you have to have enough cash that if the buyer comes a knocking, you can quickly buy what you need and give it to them. The safer bet, of course, is to cover it by owning the symbol advance. Now, why would this buyer want to come by and exercise her right over me that's defined in this standardized legal agreement? Well, of course, if the underlying symbol price has been going up in price, because if she can come and exercise her standardized call option agreement with me and buy the stock at a lower price, my strike price, from me, she can then go away and sell it at the retail price, which would be higher. And why would I want to sell her an option? Well, if the price is staying just where it is, or if the price is starting to go down, she may decide to never exercise her right, and that way I get paid a nice solid income. So that's really the thought process behind what a call option is and what options are in general. And that's how I wanted to end up today's session with you. Again, my name is AJ Brown. And if you like what you heard today, you can find me in any of your favorite podcast sources. You can find me on YouTube or on Facebook and on Instagram. And I recommend you find me in all 4 places because I post content, different content to all of these different channels. And if you like what you heard today, please like it. In fact, like it everywhere you find it. Please subscribe to me. Listen to my podcasts on Spotify, iTunes, on Google Play. Subscribe to my YouTube channel. Like me on Facebook. Follow me on Facebook. Follow me on Instagram. And definitely, wherever you can, sign up for notifications so you get notified about my most recent content. Folks, thanks for your time today. Take care.